I'd like to thank everybody for joining us for this April 2nd market and economic update. It's been a lot happening, and we think the next few years are going to be really interesting. Now, certainly in the near term, we can't predict what's going to happen with the markets, the economy, and we recommend everybody maintain a diversified asset allocation based upon their needs, their objectives, and their risk tolerance. With that being said, we think over the next few years that a lot of people are going to feel worse off, and in fact, many people will be. However, there are also some tremendous opportunities for those that are prepared and those that can focus on the opportunities rather than the negatives. What we see is rising inflation, rising taxes, and rising interest rates. We feel that unemployment will probably stay about the same or may even get worse based upon the numbers that are presented to the public. We also foresee real estate, particularly residential real estate, getting worse over the next couple of years before it gets better. And as we'll discuss in a couple of minutes, that really affects what people are being told about CPI, or the Consumer Price Index, as opposed to the inflation that you're really experiencing. What we've seen over the last year is that interest rates have stayed fairly flat. And while the government has told you that inflation is almost non-existent, most of us are spending more on the goods and services that we buy. Over the last year, we've seen coffee go up over 70%, bananas are up 20%, beef is up 38%, and even cotton's up over 131%. Certainly as you go shopping, you're going to notice these types of things. And if we look back historically at everything from Hershey bars to gasoline, what you can see from this graphic is that prices have steadily been rising over time. One of the reasons that you don't hear about this in terms of quote-unquote inflation is the Consumer Price Index, which is what the government refers to, is made up of food, housing, apparel, transportation, medical, recreation, education, and services. It doesn't include things like energy that we normally buy. And in fact, 44% of the Consumer Price Index is residential and other real estate. And therefore, as real estate prices go down, it's been offsetting the increase in other things. So while the government's saying that inflation is almost non-existent, and some of you that get cost of living increases haven't seen them, the real inflation for the stuff we buy has been increasing, and we think over the next 3 to 5 years is going to continue to accelerate. We do anticipate, as I said, much higher interest rates, higher inflation, higher taxes, and therefore people have less money to spend, and yet things will cost more. At the same time, we think that the equity markets, the stock markets, are going to move up fairly strongly. And it's very important to differentiate between what the market's doing and what the economy's doing. The market reflects anticipated performance of companies and their profits. The economy may be whatever the media is telling you. Corporate profits continue to grow in this country. And in fact, if we look at how the market's priced today, based on price to earnings, price to sales, cash, profitability, the overall equity markets are very, very cheap. Moreover, over the last couple of years, companies have been afraid to replace plants and equipment, and they're starting to spend money in those types of things. It's interesting to note that manufacturing output in this country continues to increase while the number of manufacturing jobs has decreased. So if you're looking at unemployment and jobs, that sounds like a bad thing. But as an investor, it's actually a good thing. It means companies are getting more profitable. And if you look at the chart, we can see that this actually is not something we haven't seen before. Back at the turn of the century, most of the population was involved with agriculture. As we moved to more efficient agribusiness, less and less people were farming, and we produced more food. Today we produce far more food than ever before using far less people. It's the same type of paradigm shift we're seeing with manufacturing today. Overall, in terms of an investment economy, the country's doing very, very well. Manufacturing output is up, productivity is up, corporate profits are up, and people are spending more than ever before. If we look at all of this together, we feel there's an opportunity for investors over the next 3 to 5 years, somewhat like you saw in the early 1980s. In the early 80s, the prime lending rate was north of 20%. Inflation was huge. Taxes were up. People basically felt miserable. And the stock market went up over 200%. And while we don't know how much the market will go up, we do think the direction will be strong on the upward side. And therefore, if it's money that someone doesn't need for 2 to 3 years, based upon their needs, their objectives, and their risk tolerance, it's going to be important to have some exposure to U.S. equities, to commodities, to international investments, to other hard assets, and to be a little bit careful of buying long-term bonds. As always, it's important to keep cash on hand for any short-term needs. With the election coming up, we're sure to hear more about deficits, the economy, unemployment. We think this will cause short-term volatility, but the overall trend will be positive over the next few years. Appreciate your time and taking a few minutes to listen to our update.